Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Hey, welcome back to the podcast. This week, my guest is Harry Abrahamsen, and he's the founder of Abrahamsen Financial Group. Welcome, Harry.
Great, Gary. Thanks for having me on the show.
So, Harry, give us your background.
Background is got really started in the business about over 20 years ago and was trying to find at the time an advisor to help me kind of look at the bigger picture. I had a successful company prior to getting into the business, and then basically went on my journey to find, the right advisor, the right advisor group. And then after a while, realizing that this group or company didn't really exist, it was in my mind, and decided to kind of get into the business myself and helping people strategically plan and nowadays is retirement planning in particular.
So, I guess your journey along the way, you've been doing this for a little while. You've seen a lot of changes that have happened over time. One of them, the big one being 9/11. What have you seen since then, or what happened then that made you change your thinking in the way that you do things?
So yeah, when that happened, that was a really big event for a lot of us. We all remember where we were on that day. Afterwards, funny enough, I was actually flying up to Montreal that morning, so I didn't realize what was really going on because it was happening as I was kind of trying to get to the airport. My phone was blowing up, people were calling me, and then obviously everybody was in shock. And then afterwards, probably about 2 or 3 weeks later, I sat back at my office. I had young kids at the time. I was married. I had a business, successful business. And I was like, do I have everything set up the right way at the time? And I asked myself, and the real question was, I didn't. So I called my CPA up and said, hey, I'm thinking about this. I called my insurance person and they were talking about insurance. I called my investment person, but they didn't really actually have a plan in place. So from that event, it kind of set a real big impression on me. And then over the years with people, like when you go through like 2008, which was a significant time for just people in life, right? Because you never can time certain things. So when that actually happened, I was already in the business and I watched this happen. And it was unbelievable because really once 2007 happened, 2008, everything just basically collapsed. The stock market, bonds, stocks, real estate, banks, nobody wanted to lend. And so as I kind of look back in my career with these big events that happen, I call them black swan events. They're unpredictable, right? You can't plan those things. And so if you have to plan, you have to start to think about all the things that nobody's really talking about because real risk isn't something that we're talking about. It's not taxes, it's not inflation. 2008, nobody knew what was going to happen, and no less when the bottom happened. So these events, 9/11, 2008, all these things, COVID kind of impacted our lives. It's important for people to look at things and strategically plan with partners, people, have relationships in their life. Super important. I always tell people, have a relationship, whether it's a CPA, an advisor, an attorney, because the worst thing is if ever anything really bad happened in your life, you don't want to just flip on a computer and look at the computer screen to solve a problem.
Right. I think, that holistic approach, is really important. I think that, many times, people think that it's like, okay, I need to keep everybody at arm's length. And I think that that's, the wrong approach. I really feel that, you need to build your professional team and you need to let them, talk to each other to make sure that you have the right plan for what you're trying to do.
Absolutely, it's important.
So, you wrote your book, Money Rules. Can you tell us about that?
Yeah, that was it took about a year to write it. it was a great project to take on because obviously I know you've written a book and it's a process that you go through. And so in the book, I really wrote the book for people that really have money. They've saved, they've accumulated, and they're going to make decisions in their life. It's not a matter of if they can afford, it's should I do A or should I do B, you know? And so I had fun writing it. It's kind of interesting because I write about a lot of different things in the book from tactics and strategies on maybe, how to send children to college and how to do these different things. Even though right now, for the most part, I really work with people who are thinking about retirement, they're at it or in it. So I really get a lot of joy when a client of mine reads it and they go, there's a lot of really interesting strategies in here that you've never talked to me about. And that's simply because, they're not at that stage of their life. They're past it and they're looking back on it. So I was able to kind of have fun with it. I'm a little sarcastic in it. So, just because I enjoyed that part because it gives me a platform without anybody talking back to you.
Right.
So I had some fun writing it and the tone in the book. But yeah, there's a lot of interesting strategies and tactics for people to kind of pull out, put in perspective, and think about in terms of planning or tactically trying to, plan their retirement or their future.
So, in your book, you discuss, ways of creating massive wealth. What are some of the common mistakes that you've seen, business owners and individuals make? And you talk about that in your book.
One of them is really the first chapter of my book. It's a fundamental chapter where I talk about money is not math and math is not money. And I talk about that because money behaves differently than math. Math is perfect. One plus one is two. And if you and I are around 1,000 years from today, it's going to be two. But if you look at money, $1 today plus $1 a year from today, it's never going to be $2 between taxes, inflation, planned obsolescence, technological change, things erode that dollar. And just to give you a simple example, a lot of times people will come into my office and say, "Hey, when should I take Social Security? I'm trying to figure it out." And the real answer, and you and I both know this, that the real true only way to answer that is when we know when God's going to call you home.
Right.
Because otherwise you're trying to figure it out, right? So I have all this fancy software where you run a break even analysis and you do the whole thing, but that's all based on math. And the reality is that money received earlier is worth more than it is 30 years from today. It just is. And so you should really be making those decisions, not just purely based on math. So for people listening, if they're a business owner and maybe they're really good at like math, they have to understand that money does behave differently. And so when you think about like black swan events that could potentially derail any plan, if you're not planning on it, right? If you're sick, something happens from a health standpoint. So when you're planning, if you're a business owner, you're worrying about what? Cash flow, receivables. Obviously, you have responsibilities. Same thing with planning. You have to also take your entire financial world to say, hey, what could happen financially that could prevent this from happening? That you will not have a future. Like, what are the things that could potentially happen? And you have to factor that into your plan. And some of the solutions, maybe not necessarily very popular solutions, but some of them are like, hey, maybe you might want to have this in place in case this happens, or whatever it is. Liquidity is a very big thing, right? I mean, having money that's liquid, that's not getting a rate of return for a business owner, they're like, geez, I wish I could deploy the capital or have that get a higher rate of return. So all of these things I kind of talk about in the book. Again, another one is chasing a rate of return. I always tell people the highest rate of return is your ability to earn income. If you're a
Right.
business owner, you're it. You're not going to meet some magical advisor that's going to, I mean, hopefully they're doing their due diligence, doing a good job, managing the portfolio the right way. But if you're that business owner and you're doing really well for yourself, you are that highest rate of return. And then the rest is now tactically deploying assets in areas to position what you're doing so that you can ultimately retire the way you want to retire or live the life that you want to live.
Yeah. I think that, looking at that and trying to help, the entrepreneurs try to balance all of this, because I think many times as business owners, we get so involved in the day-to-day activities and what we're trying to do, like you talked about, that we're not thinking about, the inevitable. What happens if something happens to us? How is the business going to continue? or even how's it going to continue taking care of my family if I'm no longer around or incapacitated, not able to do that. You talk some about, reinvesting, back in your business, reinvesting in yourself. Um, how have you seen that with having your multiple businesses? How have you seen that work for you?
Well, it's worked. I think one of the things that's important to understand when you're an entrepreneur or a business owner is that, you always need to try to take a little bit off the table just in case. Okay. It's a very hard thing to do. You can be a really successful business owner and make a good living, but you're really not taking a little bit off the table. So I think it's important to try to implement some thinking in your world to say, okay, I'm doing really well here. Maybe I'm going to take a little bit off the table, put it aside, okay, in case something happens. I mean, I've seen people unfortunately have a lot of money, very, $20 million, which is, and then if every time you're talking to that person, they want to make 20/40, right? And then 40/80. That's just what happens. And that person in particular literally doesn't have a dollar to their name today. So, how much would that person, what would they do to have $1 million? You know, what would they do in their life in their 80s to have that $1 million? So, just by seeing things like this and you work with people and you can see extreme high levels of success, and then you can see people that are like maybe kind of just getting by, sometimes just taking a little bit off the table is part of the solution. And so I've tried to do that myself. In my personal life, in the things that I save into, and how I invest my personal money. Sometimes it's not the most popular thing, because people are like, oh my God, insurance. But
Right.
I have 13 life insurance policies for myself. That's my choice, and most of the people I work with, I don't even say that word. It's just not part of me talking to a person that's 65 years old getting ready to retire, or a person that's 62, but they can read about it and learn about it.
Mhm.
But it's all a matter of personal preference and choices that we all make.
Right. If you could go back and talk to 18-year-old Harry, what advice would you have for him?
Okay. uh, I might have married myself. No, I'm only kidding. Uh, what would I say? Well, I think I would have probably have suggested back then to get started in the business I'm in actually right now. Um, Even though I had a great early career in business, and you learn a lot, of course, from that. But I would just try to probably say, hey, make sure you're planning a little bit better. Obviously, when you're 18 years old, you got to you have to be careful when you're 18, because they're life changing decisions. You know what I mean? And again, I mean, I got married at an early age, and it didn't work out, and I paid the price for it in my life. But those are things when you're really super young. I think when you get like into your like 30s, you have to realize like, nobody's going to really take care of you. You got to really take care of yourself. 40s, starting to get a little real, but you have time,
Right.
you know. And then when you turn into your 50s, you realize, well, you don't really have the time that you thought. You know what I mean? So it just depends on the stage of life that you're at.
So, I guess what advice would you have for, that 18-year-old when it comes to, savings and investing?
Well, my advice to them would be, it's important to speak to people and have an open mind and listen to what they have to say. You're going to meet all kinds of people with savings. There's going to be a bank. They can go down to a bank and put money into a savings account, and they can understand what that's like. They can meet maybe an insurance professional a lot of times, because they don't have any assets or money. They can listen. They don't necessarily need to do it, but they can listen and they can learn. They can maybe talk to a person with an asset based planning model, talk to a CPA for sure, like Roth IRAs. If you're 18, Roth IRA, I mean, if you're in your 20s and you get a job and you're in the lowest tax bracket of your life, and I know I'm preaching to the choir with you, right? And all of a sudden, they're like, oh my God, I can put money in a 401k. I'm like, listen, hold on. You're in the lowest tax bracket of your life. You should celebrate. take the money, save it, okay? But if you're going to put it into an IRA, and I'm not against IRAs, I love them, okay? But you're going to then build up and amass what, $1 million, $2 million in an IRA. You're going to be at the highest tax bracket. So just be careful. Like you have to just think a little bit. And again, working with a CPA, maybe, a young person that's a CPA just starting out to say, hey, by the way, what do you think? What are the tax brackets today? This is what I'm showing in terms of income. Do you think I should be putting money into a 401k? And the other thing that's a little challenge for that 18-year-old is things happen that you can't plan on. So it always bothers me when I hear people give general blanket advice. Here, put money in a 401k, and they do it. And then all of a sudden they're like 31. Maybe they lost their job. They're trying to figure out they need money. Some life event happened. Even today, nowadays, look at the cost of everything. Look at think about that, right? I mean, it's so expensive for that 18-year-old, that 19-year-old, that 20-year-old, where it's a lot different than it was when you and I were,
Yeah.
growing up at 18 years old. It's just a lot of money. So when you put money into things that you maybe can't touch till you're 59 and a half, laws may change. That's a long time. Maybe you have children. Maybe you're starting to have children and you're trying to figure out, hey, the cost of all that and where you live. Do you want to send the kids to private? Is it public? So you just have to think a little bit differently with money and the vehicles that you could invest into and learn about. Okay, if I do this, this is how that works. You know what I mean? If I do this, oh, okay, that's how that works. But also, I think like Roth for people, great move for young kids. I mean, put it away, let it go, go risky. They have plenty of time. Let it, who knows, it may not be around in 10 years.
Right. I mean, I think that I have two younger kids, and both of them I have all set up for them, and the money that they're earning, they're dumping it into the Roth, because like you're saying, I mean, they are in the lower tax brackets, and they're going to be able to see this grow over time, and then at that point they're not going to have to pay tax on it.
Absolutely.
So it to me, they're coming out so much further ahead. I like you are concerned when people are just giving blanket information out there, recommendations, whatever you want to call it, because over time that I've been doing taxes and everything, I've seen so many people where they're either in great shape financially, but it's all in a retirement account, or they have done a really good job of paying down their mortgage and stuff like that, but everything's tied up in their house. And I think that being able to look at it, and your book talks about it, of being able to have, you don't say, but they basically having different buckets of money in different places to help you, accumulate, makes a lot of sense, for sure. Um,
You know,
based
one
on,
one one thing I'll bring up with you real quick that I think is important is when you create like buckets of money or places to put money in is great, but it's also like important to learn. Like when people put money into qualified assets or people have a home, right, and it's paid off. And you and I mean, again, when you look at interest rates on a mortgage 30 year for 2.36%, I mean, you have to say, if somebody comes in, I'm like, congratulations. Um, wow, how impressive is that move? Even if you're in retirement, even though traditionally, what makes sense emotionally, what makes sense financially, I don't want a mortgage in retirement.
right,
2.3%, even 3%, 4%.
right,
You know what I'm
right,
saying? Like that's like a macroeconomically 4% on a 30-year fixed. Holy mackerel. When I first started in the business, I had a mortgage calculator to help people figure this out. The lowest rate was 5 on a 4-page document. So, those are things you need to think about. Another thing is the rules like RMD planning, right? If you accumulated that money, and if I told you how many people come in my office and they're like, I didn't even know all this. Like they should be teaching you the rules because you put the money in and you do this diligently for all this time. And then they're trying to figure out like what's the withdrawal rate percentage, and why do I have to take this much money out, and how does this really work? And then, if the markets are down 5 or 10% and they're taking the distribution, when should I take it? Should I take it in the beginning? Should I take it in the middle? Should I dollar cost average over? And they should learn the rules of all this stuff. So there, people are putting money away in from an early age, their entire life, getting into retirement, and they're almost like they have to learn another language to just understand how it actually works.
Yeah, yeah. And I think looking at that also, and that's another reason why I like Ross also, is because that helps with some of that. And there are a lot of other, investment strategies that people can use to help, from a tax standpoint, and not having to worry about, okay, if the market's down, when I have to take my distributions, how much have I lost? I think and it's more, and as professionals, lots of times we're psychologists with people, talking about not having that mortgage in retirement. The number of times that I've had that conversation with people and saying, hey, your rate's at whatever 3%, what's your return on your investments, that you're going to have to cash out to pay down that mortgage. And looking at that and having them also look at it, it's like, okay, well, if I sell something off, I'm going to have to pay capital gains on that. And then I'm taking that money out of the market that I was earning, whatever, 8%, even, 6%,
Right.
so that does it truly, and again, going back to your, original thoughts about it's math, just looking at it, it's math and what makes sense.
Yeah, I mean, and also another component is control, right? Think about it like if you are in retirement or getting ready to retire, and again, we would never generalize or advocate one thing or another on the show right now. But the point is, let's just say you're entering retirement and you have a $400,000 mortgage on a home and your net worth is 3.5 million. Well, of course you could pay the mortgage off anytime you want. It's your decision. Now, if you're getting ready and you're getting into retirement and you have $200,000 in an IRA and that's it, and you have a $400,000 mortgage, there's a problem
Different
going
story,
on
right?
because you can't get rid of that mortgage. So it's a matter of control for people, and a lot of times it's sitting down with them and saying, "Hey, okay, I would rather you have the money in the bank, and then if you want to, you choose, pay it off. Okay. But that's a decision that you can make. And then, of course, there'll be a lot of people like just because it's so ingrained into who they are, they're just not going to have a mortgage until they realize that their daughter went to a different school and she's got a nursing program in a different state and she wants you to buy a condo that you didn't plan on. And so that you're going to be downsizing your house that you're living in, that you've lived there for like 35 years. So you
Right,
downsize to buy that second home that's your retirement home. And you did everything by the book, but your daughter, that's a single daughter, wants you to be closer because she's upset and she's going to get engaged. So now you're getting a mortgage on the condo and you're like 67 and you're like, wait a second, I didn't plan on doing that my whole entire life.
right.
Things like that happen in life.
And I think that's something that's important, is that, being able to have the team of professionals, that if that is your decision and you are changing your plan, that they can be there to help you create that new plan. And I think that's something, as a professional, I try to tell everybody, it's like, whatever your plan is, make sure that you have some flexibility to it so it can shift, because things are going to happen. You talk about the black swan events and stuff. It's like stuff's going to happen. You just have to be able to be able to shift and move with it.
Yeah, I use an example in my book, the game that we played as kids, red light, green light, right? So, like, we're all lined up, green light, you're running like a maniac down as fast as you can, red light, you stop. And
Right.
of course, you go through that sequence and there's a winner. Well, in life, if we just said to someone right now, literally like red light, like stop, you can't make a move, you can't sell a position. This circumstance happened, like what would happen in your life right now? So if you could just prepare yourself a little bit to make sure that you're protecting like what you do have in case something like that happens. I'll tell you a funny quick story that happened. That I'm going back years ago. I had client in New York City, and I had suggested for them to get renter's insurance. Okay. I said, just get renter's insurance. And he's like, Harry, listen, I'm like X amount of stories up in the building. I don't need to do any of this. And I said, listen, it's probably going to cost you like $130 to get
Right.
renter's insurance. You should just do it. Well, I don't know if you remember the picture on the Mets Lytle when the plane hit the building.
Yeah.
Okay. Well, it was my client's building on the same side, a couple of stories up. And he called me up. He said, I can't believe this happened. And he went out and obviously got renter's insurance. So who would think, right? In New York City,
Right.
big buildings, somebody saying, I don't need this for something that's like $136. It's really nothing. Just have things set up in case it does happen.
Yeah. Yeah. All right, Harry, we've covered a lot of stuff. I've enjoyed our conversation so far. What do you wish that I had asked you that I haven't?
Let's see. I would say, I don't know, we covered a lot of really good things. Maybe something like, I'll give you one thing. Maybe if a business owner really couldn't actually save, what's something that they would actually like, how could they get started? Like, what could they do? I would suggest that they would probably try to open up something called a WCA account, wealth coordination account, it's just a bank account. And if they could save on their own without working with an advisor, 15% of gross earnings, that's a good thing if they can do 15. If they can't do 15, they can do 10. But they can put that money away. And after 1 year, they can look at that account and be like, okay, I've accumulated X amount of dollars. So if somebody says, I'm going to do $1,000 a month, that's their goal. But over the course of the year, they really have 6,000. The true save number is $500 a month. Like
Right.
that's their number. Okay. It's not 1,000, but they can now invest $500 a month without worrying about cash flow for the next year because they're going to now save that 500 into that account again to refill that bucket up. And then they can deploy that into any kind of investment strategy. So if they can do that for 1 year on their own and be true to themselves, whatever their budget is, and business owners, $1,000, 2,000. Next thing you know, they have $5,000 in the account. That 5,000 divided by 12 was the real number that they could actually save. So that's one thing that I think that people can use, especially if they're a business owner or an entrepreneur early on in their career.
That's great advice. Harry, if people like what they hear, how can they reach out to you? Where can they find your book?
They can find it on Amazon. They can Google. I mean, they can Google my name and type the book in, Money Rules. They can go to Amazon and type my name in. The book will pop up, and then they can go to our website, abrahamsenfinancial.com, and there's a whole contact page there. So that's the best way to reach us.
Great. Harry, really appreciate your time today. Great conversation. Look forward to staying in touch with you.
Great, Gary. Thanks for having me on.
Sure. Hey, this week my guest was Harry Abrahamsen, and he's the founder of Abrahamsen Financial Group. We'll see you guys next week.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.